let me start by saying how great pleasure we have today, and indeed great honor, to welcome the guest speaker today, Professor Stephany Griffith-Jones. Professor Stephany Griffith-Jones is not easy to introduce her because she's a very well-known figure. So when economists get together and you can't just introduce. She's already a brand in her own right. So she's now emeritus professor, professorial fellow at the Institute of Development Studies at the University of Sussex. But that's not her only role. She's also at the same time the financial markets director at the Initiative for Policy Dialogue at Columbia University. So basically, you see, she will be traveling on the next flight between the UK and the US, straight across. But at the same time, she's also the research associate at the Overseas Development Institute, ODI, here in London, as well as non-resident fellow at the Center for Global Development, CGD, in Washington, D.C. So that is what high reputation does for you. It basically, you are strong across the continents, and basically because of the time difference, you wake up in the morning in London and then and the evening or the morning in the U.S. But in particular, she has done this excellent work over so many years on capital flows, and is so innovative. Every time I talk to Stephany, we generate a new idea. So it's just highly productive, brain. And for the last couple of years, she's been working on development banks. And I thought it would be great to have Stefan to share with us the experience of development banks, in particular for Africa, mainly because in Africa, it had been taken for granted that the role of national development banks, was gone in the 70s and 80s. But at the same time, Stefan and her colleague, Professor Campo at Columbia, they did this work in Latin America that shows how national development banks are so important, so critical at this moment in time when we are looking for long-term financing. And so she's speaking about this, but she also tell you of some of the leading think tanks she's been engaging with and some of the high-profile roles she has played in taking this conversation further. We are fortunate to have her here. We're also fortunate to have here with us in this particular meeting some important practitioners and policymakers and top researchers. I can't possibly go ahead and introduce so many people here, but I would like to just single out a couple of people here. I just want to recognize Dr. Kupukire Mulambo, the Deputy Governor of the Reserve Bank of Zimbabwe. Thank you, Dr. Mulambo, for being able to join us. And he is not only a researcher in his own right, but also a policymaker. And also Ms. Patricia Ojangole, who is the CEO of the Uganda Development Bank, actually having her hands on being steering one of the national development banks that Stefan will be talking about. We also have some high profile in the ambassador and high commissions in London, especially Mr. Kibona from the Tanzanian High Commission, and also some eminent people here. Dr. Peter Rose, the former finance minister for Seychelles, whom I've seen also here in the audience, and also some of the leading researchers who are looking at these issues, in particular our good colleague, Professor Bojo from University of Gothenburg in Sweden. Okay, so it's good to have this mixture of high-profile people, from top researchers to high-profile policymakers, high-profile practitioners, so that we engage. We'd like to harvest all your views to be able to share all these views, which you can post in the chat room, also which you can just put up your hand and share your views with us as we go. So once again, we are very, very, very pleased, delighted, honored to have you here, Stephany, with always your brilliant mind, brilliant ideas today. Thank you. So please, the floor is yours.
Thank you very much, Victor. Thank you for your extremely kind introduction. It's always a pleasure to work with you, both intellectually and also from the marvelous fellowship we have together. And I'm also very honored to be in this distinguished audience. I'm very delighted, including some people who I know very well, like Patricia Oganjote, and I've just been quoting you today, actually, so it's like fantastic to have you. So my presentation, I would like to divide, if possible, in 4 parts. I first would like to do a broad introduction on development banks, which draws on my recent research, particularly also on this book that Victor kindly referred to, which we co-edited with Jose Antonio Campo, and I will send the details afterwards. It's called The Future of National Development Banks. Then I want to talk a bit about the conference. We've just had a major conference linked to the first summit on development banks, which was hosted by President Macron, and where the UN Secretary General spoke, the managing director of the IMF, and it was hosted by President Macron, and there were a number of heads of state, including several from Africa. And of course, the CEOs of most development banks. There are actually 450 development banks if we count both national, regional, and multilateral development banks. And in total, they have over $11 trillion of assets, $11 trillion of assets. And annually, they lend about $2.3 trillion. So they are, which is equivalent actually to about 10% of world investment. So they are really quite an important, though I would say quite understudied till recently, institution with huge potential. So then I want to present some of the main conclusions of our research for this conference. Thirdly, I want to present the paper that we prepared for that with co-authors, and I will send the PowerPoint afterwards, which relates to the issue of risks and instruments that are best appropriate for dealing with those risks. And finally, if I may say something on the challenges for African development banks, there's a huge potential for further growth in them. So let me start, if I may, by saying that we are facing in the world economy, and particularly in the developing countries, of course, major challenges which require very large levels and a major reorientation of investment. We have to, of course, deal, as you all know, with the very high problems caused by COVID, including support for health, as we were just talking with Meng, but also recovery of the economy. And in that sense, developed countries have been actually responding very strongly with their own fiscal policies, but they have not, and I will argue that later, perhaps done an equivalent amount of effort to support developing countries, including through multilateral and regional development banks. So we have this immediate challenge, but we also have to meet the urgent needs of transformation to low carbon, more dynamic, fairer economies. And these are very urgent. We know the planet cannot wait and cannot be replaced, sadly. And poverty that has been falling very significantly in the last 10, 20 years is estimated, for example, in the case of Africa, by the United Nations Economic Commission for Africa, to be increasing dramatically this year. And perhaps the major progress that has been so successfully achieved, both in Africa and in Latin America, is at risk of being reversed in 1 year. So there is a need both for short-term finance for saving jobs and companies as a result of the pandemic, and major long-term investment for structural transformation. Now, unfortunately, the private financial system, as exists now, is not really fit on its own to deal with these major challenges. Doesn't provide not enough long-term finance, for example, for key infrastructure, doesn't fund enough SMEs, especially new and innovative ones. It is relatively willing to fund new technologies due to the problems of uncertainty. It is less willing to fund, especially on a sustained manner, low-income countries. It has, for example, and lower middle-income countries. It has, in certain moments, increased private lending and investing in, for example, some low-income countries that they like to call frontier markets, but this tends to be very cyclical and has, for example, now practically completely dried up, as you know better than me. So this is a major problem because during and after crisis, private capital flows are very deeply pro-cyclical. So this makes us think that there is quite a radical need of rethinking of the financial sector so that both domestic and international to provide sufficient finance and channel it to the right sectors, companies, and of course countries. And this is, I think, true nationally and internationally. And I think we have to, in some ways, think about a new development new development finance paradigm, which is not completely new because it was quite prevalent after the Second World War in the Bretton Woods period. And it is a financial system which is a sort of mixed economy approach, where there's an important role for public development banks, of course, working very closely with private finance. And I think this new vision is particularly important for also for African economies. I think the needs that development banks can meet can be framed in a little bit of theory. I mean, the efficient financial market theory that was so prevalent, particularly in the 80s and 90s, didn't really recognize the need for public financial institutions. But I think after the global financial crisis of 2008, 2009, if you like, theory has been significantly weakened. So what is the first justification for public development banks or public mechanisms? The first is provided by the argument for credit rationing and market failures in private financial markets. And I think Stiglitz, in his 2004 book, made a very nice case, saying that it's not that governments are perfect and financial markets are bad, but that in the financial sector, the private financial markets have more failures than governments do. And this, I think, is a key argument for government intervention. And then there is, of course, the unwillingness that I already mentioned of private finance to, on its own, finance particularly activities with uncertain returns or where there are very important public externalities. And this problem of uncertainty is, of course, magnified now. It's magnified normally after financial crises or other crises or macroeconomic shocks, but it is also, this particular economic situation is perhaps best characterized as uncertainty, which, of course, private finance doesn't like at all. Additionally, one can think of development banks as part of the development state or as Mariana Mazzucato likes to call it, the entrepreneurial state, which is one that not just covers for market failures or market limitations, but creates new markets. For example, very important in innovation. So it sort of leads, it helps steer the markets, but very much clearly working with them. I mean, public development banks are public, but they work very closely with the private sector, both financial and the corporate sector. And then I think it's very important to stress that there are the needs that these banks play key roles in the developed economies, where they're actually very important, in the emerging economies, and also in the low-income countries. So they are across the board, nationally, regionally, and multilaterally. And for example, an example about how this increasingly important also in developed economies, the role of the European Investment Bank, the Bank of the European Union, has had its role significantly increased, including with more resources, first as a result of the 2008-2009 financial crisis, and now because of COVID. And finally, we have, of course, the creation of new development banks like the Asia Infrastructure Bank and the New Development Bank, or so-called BRICS Bank, both of which are also very, very active in Africa, though the Asia Infrastructure Bank is of course, mainly focused on Asia. Now, I want to stress one key element, which is leverage, because although the capital, and particularly the paid-in capital, is provided by governments, the funding of these banks, for example, the Development Bank of South Africa, is largely relying on private capital markets. So these banks issue bonds, they borrow in the capital markets, and then they lend to usually to the private sector, although also sometimes to governments or municipalities. And so this combination, and plus also it co-funds with private sector. Going back again to the European Investment Bank, they co-finance. They never put more than 50% of the money towards a project. The rest has to come usually from the private sector, sometimes from governments. And so now in this period, we've had a sort of renaissance of development banks at all levels, as I said, very much stimulated by the global financial crisis and now by COVID. And so we have, as I mentioned, these very high levels of assets and yearly loans. And with two colleagues, José Antonio Campo and Régis Maradon of the French Agency of Development, AFD, we thought, if these banks worldwide increase their lending by 20%, that could generate an additional over $400 billion, which could go quite some way to support the needs of developing countries particularly in Africa, Latin America, and in the poorer countries in Asia. And if you think about how they would co-finance with the private sector if you like, at a conservative estimate, this would be even doubled. There would be a leverage of 2, and therefore you would be generating $800 billion annually if they just increased their lending by 20%. So I would like to, propose that, and I may also, if I may, we wrote a Project Syndicate article about this, which was actually reproduced in several African countries, to my delight. I will also send that in the package. And this renaissance has also been, if you like, recognized by this research program that we're running, and particularly by the research conference and the summit that was held just a few weeks ago, and which is only, if you like, the first stage. And we're then hoping to do a second summit at the end of next year, hopefully not just virtual, and also continue with the research program. Another interesting development, which I should maybe add, is that it seems very likely that the new US administration, the Biden government, Biden-Harris government, will create some kind of new significant federal public investment institution to deal with the big challenges they have on inequality, but also on climate change, innovation, and so on. And there are discussions. Some bills have already passed through the House of Representatives, and some there's a lot of discussion about the scale and the ambition. But it seems very likely, and I think this would give a further impetus because we have the dynamism coming, if you like, from Asia through AIB and NDB and the activities of the Chinese Development Bank, which is, of course, the largest development bank in the world. It has on its own about $2.5 trillion of assets, but also coming from Europe through the EIB and the national development banks, and also coming from the US. And so I think the dream is to take this to Africa. The dream is to take this to Africa. So very quickly, I will go through the roles that development banks play. So the first one, I think, is to finance the major investment needed, as I mentioned, to structural transformation and productive diversification, to increase productivity and to change significantly the economy. And of course, one of the big advantages of development banks is that they lend long term. They can fund themselves on the capital markets or get money from governments, and they lend typically for 20 years, which is very different from the kind of lending you can get from private capital markets. And I think another interesting feature is they work closely both with the private sector, but also with governments to help design the policy framework that will make their lending much more effective, especially in key new sectors. Secondly, of course, they are counter-cyclical, which is very crucial to be able to maintain the investment, to sustain it for long-term development. Because if you have a crisis or macro shock or COVID, and you typically then cut back investment, both public and private, as is occurring this year, then you will not only harm aggregate demand in the present, but of course you will harm future growth in the future. And we have evidence, for example, coming from the World Bank, that in the global financial crisis between 2007 2009, on average, national development banks increased their lending by 36%. And the World Bank and the regional development banks have also played a major role. I think the DFIs, for example, European DFIs, the counter-cyclical impact was less clear. And I want to stress afterwards that this national response has been very positive. For example, KfW has increased its lending in Germany by about 24% of GDP, very high levels this year due to the COVID crisis. But as I want to discuss a bit more later, there hasn't been a significant increase, and there cannot be a significant increase by, for example, the lending of the African Development Bank, because they are very constrained by the availability of capital which they have. And therefore, it is very urgent that there is a recapitalization of all regional development banks, or an acceleration of the increase in the paid-in capital, because the capitalization of the African Development Bank, as many of you will know better than me, has been over a 10-year period. So they're getting very small tranches every year. And that was okay, perhaps in normal times, but it is not okay. It's very problematic in these difficult COVID times. And this very timid attitude of the G20 and of the developed economies is actually in quite sharp contrast to what happened after the global financial crisis of 2008-9, when actually in London, Gordon Brown chaired the meeting of the G20, which took very bold steps, increases in SDRs, but also increases in IMF lending facilities, volumes, and very sharp increase of the capital commitments to World Bank and regional development banks. So I think there is a very important political and policy discussion about how to accelerate this. So other functions of development banks are its ability to help develop capital markets. For example, many of these development banks have helped create local currency markets, which is, of course, so important. And possibly new instruments. For example, venture debt is a sort of debt instrument which converts into equity, has been used increasingly by the European Investment Bank and KfW. And I think it's interesting to think through whether that kind of instrument could also be relevant for lower middle income countries and leaks in, say, the African context. I think this is an interesting instrument. And in fact, where I was just interviewing recently the Vice President of the European Investment Bank, and they were very excited because this vaccine, which they're actually beginning to give in the UK, has been developed by Pfizer and by this two Turkish scientists based in Germany, was funded in a major way with a €100 million loan by the EIB through this venture debt. This is something I have not heard in the British media, but I think it's a very important illustration of the good things that development banks, if they're applying well, can do. And what I found interesting is that they also have a team of medical experts in the EIB, as many development banks do. They have a lot of technical expertise, and therefore they are able to evaluate these new projects or these new companies, including this one, and then can support them financially and, if necessary, through technical assistance. So a fourth function is to provide inclusive finance. And of course, this is also very important in developing countries, and particularly in Sub Saharan Africa, loans to SMEs, micro enterprises, combining the funding, of course, with the technical assistance, and using diverse instruments. And I think, again, there, Victor kindly mentioned our book. There are these correspondent banks or correspondent institutions, for example, in villages in Colombia, which also channel funds to very small companies. And this and other mechanisms can be also of interest in Sub-Saharan Africa, as are mechanisms that are already existing in African development banks. And finally, last but certainly not least, development banks can help finance public goods, especially, of course, now climate mitigation and adaptation. And again, this expertise, which is based in these development banks, working with the private sector and with the governments, can have a valuable impact. And I think here there is power of coordination. And here I would like to illustrate with an example of solar energy. In Germany, the KfW, one of the largest development banks in the world, helped create the funding for solar energy, and also helped the government define the policy framework for this. And this led to very successful introduction of funding for solar energy, which was then increasingly taken up by the private sector, by the private financial sector. And then this baton, if you like, was taken up by the Chinese, who, of course, and particularly by the Chinese Development Bank, which again, working with the government, defined the policy framework and then started massively funding investment in solar energy, of course, on a much larger scale, given the scale of their economy. And they did something not so good for the Germans and the Americans, which is some of their companies in solar panel production went bankrupt, but they reduced significantly the cost of solar panels. And one of the reasons why in Africa, in Latin America, solar energy and indeed in the developed countries, solar energy has become much more competitive is because of this investment, both in Germany and in China, which in both cases was funded by development banks. So it's a nice other case of success story. So they are helping to implement government policy and also helping design it. And this is very interesting. In the authors of the KfW chapter in our book show that. But they're also, of course, mobilizing private funds. And then in this book, we concluded that generally we thought from the case studies that we did, of course, there are exceptions, these development banks have been generally successful because they can adapt to new challenges, to new activities. For example, a lot of support, countries like Chile, Colombia, goes to supporting entrepreneurship, technological innovation, financial inclusion. These are, some of them are very new challenges, like the idea of supporting entrepreneurship. I think it's very, very new. New sectors, digital, renewable energy, energy efficiency, and other important sectors. Now, of course, electromobility. New instruments, and if I have time, I would like to talk about that. Loans, traditional loans, but also guarantees, equity, and more sophisticated instruments. So I think just to finish, what are the, if you like, the preconditions for development banks to work successfully? And we're trying to deepen this in the research. One is, of course, good macro policies, a good macro framework. Very important, the country having clear development strategy, the clear policy objectives at the national level, hopefully aligned with the SDGs and the Paris Agreement, but also very clear policy objectives given to the development bank by the government. But at the same time, institutional autonomy. These development banks should be independent in their decisions on individual loans. But so these, and from the development banks themselves, I think sufficient scale is something that is very important, and I think very relevant for the African context. Because if you want to have a big impact, for example, in COVID, you want to have a big counter-cyclical impact. If the bank is small, even if it increases the loans by 50%, but if it's 50% on a very small scale, the whole macro impact will be small. If you want to have a major structural transformation, if you want to invest significantly in infrastructure, the case of Africa, electricity, you again need large-scale development banks, which can also give fairly large-scale loans where that is needed. But of course, there are other preconditions. I think an important issue that we've started to do research on is good governance. So as I said, good governance is tricky because you have to have a close link with government, because you need to implement their policies, but you don't want to be captured by narrow political interests. And you have to have very close links with private financial institutions, both and private companies. But again, you don't want to be corrupted. So you have to be arms related, but in a sense of building bridges, but not captured by narrow interests. And I think that is quite tricky, and I think it's a very interesting area of research. Thirdly, you have to use most effective instruments, direct loans, for example, or indirect loans. What should be the role of equity and guarantees? And if I have time, I'd like to say a little bit about that. And I think one of the key challenges that we've been trying to study now is how you can maximize development impact. Because commercial banks, in a way, have an easy job, because all they try to do is maximize profits, particularly short-term profits. because they tend to respond mainly to their shareholders. One could argue that maybe they should have a broader agenda. But development banks have to walk, if you like, on two legs. They have to, at the same time, have a relatively good financial situation, and they shouldn't have losses, and ideally some profits are good, because then they can increase their capital from their own resources and carry out bigger activities. But the main challenge is how to maximize development impact. And I think there's big issues about how you measure development impact, how you monitor. And I think this is like a second level of research where I would love to hear your thoughts. So development banks should, returning to the financial side, should make profits, but not be profit maximizers. They should be maximizers of development impact. Okay, so if I may, I just want to take us through very quickly some of the policy recommendations that we have extracted from this research program, where we had 15 papers, and we extracted policy recommendations for decision makers. And I'll try and be quick. And this is a research network, which includes a lot of good researchers, and also institutions like the United Nations, the OECD, think tanks like ODI, and a close involvement also with Chinese colleagues, the Institute of Structural Economics at Beijing University. And as I mentioned, maybe we were a little bit, we found some difficulty in doing enough work on African development banks, and we certainly, although we tried, African policymakers tend to be very busy, and we're hoping very much in the second stage see that gap and to focus a lot on development banks. So, what are some of the main conclusions? One of them, very dear to me, is that, and I've already mentioned this point, that development banks need to have sufficient scale to perform their functions, and that there is particularly this urgent need to capitalize regional and sub-regional multilateral development banks. For example, the Inter-American Development Bank has had no capital increase. The African Development Bank did have a capital increase, but as I said, is being dispersed over 10 years. And the World Bank has had a capital increase in 2018, but it wasn't very large, and they're also running out of money. And so the main problem they're facing is that they don't have more ability to lend. And if anything, they've done quite a lot this year, but will be very, very severely constrained next year. And also, one of the other conclusions that national development banks should also need further capitalization, and that perhaps some of the funds mobilized in the context of COVID could be devoted to this end. For example, the Costa Rican president has an interesting initiative of dispersing 500 billion of additional aid and loans to developing countries and low-income countries and emerging economies. It's quite ambitious, but one of the channels to do that could be through development banks. And also, finally, there are about 30 countries in the world that do not have development banks, and it would seem very important and interesting to create. Then that's one overall important conclusion. Another conclusion is that the development banks perhaps have to move from being what was called project takers to project makers. That is, it's good to respond to the needs of, say, private companies that come and ask for funding for their projects, but at the same time, there's also a need to create help create new sectors, new projects, development hubs, for example, in the field of sustainability, and then they can be showcased these development banks, and then private financial sector can follow. So the idea that the development banks have to be more proactive and define programs and projects, including, of course, special funds for technical assistance for project preparation or funding. Thirdly, it's very clear that there is a need to maximize, where it's possible, private sector finance for things that they would normally not fund, so that they can jointly work to finance these development objectives. But it's crucial to do that in ways that maximize the sustainable development impact of these flows, not leverage for its own sake, but leverage to maximize development impact. And I think sometimes in the discussion of, for example, from billions to trillions that the World Bank has argued, this dimension, this qualitative dimension, is lost a bit. Then we had several papers on financial regulation, and we found that the financial regulations that are available through, for example, Basel III, capital adequacy, and so on, are not always appropriate for development banks. In some aspects they are, but for example, they penalize long maturities. And this is exactly the essence of development banks, to lend for large projects often and at long maturities. And it's not a big problem in development banks because their funding is also long-term. So there isn't this kind of maturity mismatch, which the financial regulators rightly are concerned in terms of financial stability with commercial banks. There's also issues of concentration on large projects, because sometimes countries just need major investments, I don't know, hydroelectricity or something like that. And if you penalize concentration, this is very much a complaint I also heard in discussions we had when we were in Ghana, in a seminar, that there is a difficulty through Basel to find sufficient funding for long-term projects. And so how should there be special regulations for development? And the other big challenge is how to incorporate climate risk into financial regulation and into consideration of the own development bank. Risks of, nature shocks, for example, which is such a new and important area. Then there are these issues about good and independent and strong governance, and also of development banks working as a group. There's a lot of talk at this conference about how the links should be strengthened, and I think in particular how the support, which the system, if you like, the architecture of development banks gives to banks, national development banks in the smaller and weaker economies, like in Africa, how they should provide maybe more cheaper lending, how they should provide concessional finance where it's needed, how climate finance institutions should support and channel some of their work through their funds through national development banks. So these are the main conclusions. So I would just like to finish by presenting a little bit the paper that we prepared for this research conference, and it's co-authored with Shari Spiegel from the UN, Jejun Ju from INSEE, Beijing University, and Marco Carreras and Natalia Nakwi. So we're a multi-author paper. So I want to talk a little bit about the analytical framework, and then talk a little bit about how that's applied to specific instruments. And I think this is very much work in progress. So in the analytical framework, we started by differentiating between risk and uncertainty. Frank Knight in the 30s, I think, or 20s, made this crucial distinction in theory that uncertainty is when you cannot measure what is going to happen in a certain period. Risk is also very difficult to measure, but in theory it can be measured. And there are all these models and so on that try to measure. And I think this is an important distinction, because when we have these periods, and COVID, as I mentioned, is an important example, when we have so much uncertainty, the need for instruments becomes different. For example, private banks on their own don't want to lend. And if you look at even in the UK or in Germany, most of the lending that has happened is the government guarantees. Possibly even in the UK at one point they gave 80% guarantee, and that was not enough because they had to give 100% guarantee, or through public development banks. So actually Arrow and Lind in a classical article say that when uncertainty is so high, there is a need for public action, and he particularly recommends guarantees to deal with the problem of uncertainty. The other distinction we had in our analytical framework was between, if you like, real economy risks and what we call financial engineering risks. So this occurred to me when I was listening to Mariana Mazzucato, who loves risk, but she's talking about innovation. She's talking about going into new sectors, new technologies, of course, also new countries. That is fine. That is what we call real economy risk. And it's good for development banks to take these additional risks because they have a potential high payoff in terms of development. You can fail in these projects, but you can also have major development or other impacts. And this case that I gave with the vaccine, that program has had a lot of failures, but it produced this fantastic vaccine, which they began to give yesterday. So these are the good risks. They also include, of course, lending to SMEs and lending to poorer countries, which are maybe seen to be less creditworthy. So all that is to be encouraged. But that is different from what one could call financial engineering risks, which are risks which are embedded in the instruments themselves, and which, for example, have the advantage of leverage, but have the disadvantage that they create contingent liabilities for the development banks, and then in the end for the governments and the taxpayers. And also they reduce the ability of development banks to do what we called policy steer, that is to channel the funds into the sectors that are most priority. So the main challenge is therefore to choose instruments in these constraints which maximize development impact and minimize excessive financial engineering risk. And I would argue, because people say, oh, we have to work with the private sector. Of course we do. But there could be a sort of hierarchy of what are the best ways to involve the private sector. So, for example, like I mentioned, a development bank can borrow on the capital markets and then use that money to lend for its normal operation. That is a very good thing. It can co-finance with the private sector, with private lenders or private investors. That's also fine, because they are defining what the key loans are, what are, of course, listening to the private sector, what are the priorities, evaluating the project, and then they inviting the private sector to go along, which they often are very happy to do. And there's also a third way, which is on lending, which is that the development bank doesn't do the transaction itself, particularly the smaller transactions, more decentralized, but on lends, mostly through commercial banks, or possibly through regional or sub-regional development, national banks. So I think all that is excellent. The latter, you have to be a little bit careful not to lose the policy steer. I mean, it's good that you're decentralizing the decisions to people who hopefully have good branches and local knowledge, less asymmetries of information. But it's a bit problematic because you lose a little bit the control. So you could give clear guidelines. Can you lend more to SMEs? Can you pass on to the SME users the reduced cost because we're lending you, even if it's not subsidized lending, but because the development banks tend to borrow more cheaply on the capital market. And then the monitoring, which is difficult if the lending is indirect. But within that, of course, there is this tremendous advantage that you have people with the local knowledge on the ground. But then finally, there are these mechanisms, I would say more common in developed economies, but I think they're trying to kind of introduce them also in emerging and developing countries, which is to have all these very clever instruments, which may help with leverage, but which often are also very good at hiding risks. And these risks are very often in the future. And so I think, as the British say, the devil is in the detail. And I think it's very important to minimize this kind of risk linked to instruments. Just to sort of summarize, what we take from a little bit from this literature and from our analysis that, for example, guarantees are particularly good for regulatory and policy risk. So if there's a risk, for example, that a private investor would build a road and that the government would build a parallel road near it, which would diminish the traffic and reduce future revenues, it's very good to have guarantees against such policy risks. And it's very good for the government to give them because they are also themselves implementing. Or if a company buying electricity for the government is publicly owned, it could change, for example, its tariff policies. So it makes sense for the government to give a guarantee that this will not happen. So guarantees are useful in that sense against policy risk. But they're also useful if there's high risk aversion, as I mentioned, like uncertainty today, or in projects that are very risky. But, and of course, if there are important externalities, for example, social externalities, if you're lending to very poor people or very small companies or in fragile states, if you're lending for activities that are introducing new green technologies that are not fully commercial, it is also appropriate to use subsidized credit. So not just loans, but also subsidized loans, preferably, I think, time limited, and with the market failure very clearly outlined. However, if Greenwald and Stiglitz have pointed out that if the development bank doesn't have information advantages, public guarantees do not necessarily give better results. So we have to have situations where if you like, the public development bank has a comparative advantage in evaluating the information, because if it doesn't, it will suffer the same problems as the private lender. Looking in terms of direct instruments and indirect instruments, a preliminary conclusion we have, and we want to study that more, is that direct lending has the advantage that it can be better for counter-cyclical aims. The public bank can respond more quickly if it's doing the loans themselves. And finally, you can try and increase the impact of development loans, banks loans, or investments, which is very important. But it's also important that you can do this increased impact through the role of increasing capital for the development banks, which may be in some ways a cleaner way. So just to summarize, and here we're talking in normal times, subsidized credit has the advantage of raising returns, which is useful when there's insufficient returns, given a level of risk to attract private investment, and there are important externalities. And of course, in the developed countries, they're thinking very much of the green transformation and subsidizing initially activities before they become fully commercial. A lot of talk now, for example, about hydrogen as an alternative source of renewable energy, but still quite expensive. And there are also credit is also good direct loans for countercyclical aims. As I said, guarantees reduce risk, and so they're appropriate if there are idiosyncratic individual risk when there's high risk aversion by private investors. Also, and this is, I think, of interest, particularly to some of the poorer countries, say in Africa, when financial systems are relatively underdeveloped. So by giving guarantees, for example, to the banks, it may encourage them to go into particular sectors or segments of the economy in times of high uncertainty. But also guarantees are more difficult to assess the development impact. And finally, I haven't talked enough about it, but I think it's very important. Equity financing is very interesting. Firstly, because from the development bank point of view, it gives upside potential. So if the project fails, they may lose the money, but if it does well, like in the case of this vaccine or some of these other investments that I've mentioned, and the company becomes extremely profitable, then the development bank will capture some of these profits, and it can use it then to, for example, increase its capital and lend more or subsidize activities that need to. So that is, but there's also the fact that now companies have been borrowing like crazy under COVID because, of course, they don't have revenues and they need working capital to pay their workers and their suppliers. And so they're going to get extremely leveraged with debt. And so equity may be an attractive instrument to use to provide, lower leverage in the future. It's not easy because it's expensive in terms of capital requirements. So there are some interesting hybrid instruments, like I mentioned venture debt, which is used very successfully, it seems, by the European Investment Bank and KfW, which means that you give a loan, but it has an equity kicker. So if the company is doing very well, the development bank can say to the company, I want to exercise my equity kicker or warrant, and then I take a position within the company, not on the board, so there is no kind of governance intervention, but I benefit from the profits. And I think that has less capital requirement. I think I'm running a little bit out of time because I'm very interested to hear what you have to say. I was going to talk, but it's a bit preliminary, what has been the response to COVID and also further research. So in terms of further research, we're interested in these equity and quasi-equity instruments, how you apply this analytical framework to different sectors and countries with different levels of development, how rating agencies rate development banks, and how they rate the changes and possibly the need of some regulation. Because, for example, the rating agencies don't like if development banks or others give standstills on debt. And this discourages people from giving them and borrowers to seek them. And I think in difficult times like the current one, this is not the best way forward. And then finally, we want to look at advantages and disadvantages of direct or indirect instruments. And also, as I mentioned at the beginning, we want to look at development banks in different contexts. China, European Investment Bank, but then particularly in Sub Saharan Africa, where development, and I don't have too much time, are relatively small as proportion of GDP, with some exceptions, like for example South Africa, the DBSA, and they tend to be too small, for example, to play a big role in funding of infrastructure, which is of course a sector that is much needed, where government spending is limited by lack of fiscal space. where private investment is limited only to certain sectors, to the most profitable sectors like telecom, and where development banks, I think, could play a really important role. So there are a number of challenges there, and I'm really looking forward to your comments and questions and advice on this future research. Thank you very much. And thanks again, Victor, for the marvelous opportunity to address this audience.
Thank you so much, Stephany. Thank you so much. Definitely, as I expected, you have, exceeded all the expectation. You've covered every element very thoroughly and fundamentally, and which are particularly important for researchers, policymakers, practitioners. And I hope, since we have the opportunity of having some practitioners on board, including Patricia, I hope that they'll have some comments to make later in the intervention. I think the discussions we've been having about this aspect of looking into with a fresh eye into the business models and the new roles of development banks, national development banks, particularly, not regional development banks, but national development banks in Africa is really, this is the time. And I hope that, this is the basis for a new volume in which as many people as possible, including people we are blessed with to have here, will contribute some chapters, and we drive this excitement, especially on case studies. There is great emphasis for long-term finance, especially for the private sector, and with the threat of small. I think the time is now. So we have received quite a number of comments in the chat room, and I think there might be also people putting up their hands. But let me just visit the chat room and see some of these questions which we could look into. I think there is a question by Jun Hong Young. So can I ask you, Jun Hong, to put this question quickly rather than me reading from the chat room?
Okay, thank you so much, Stephany. I think it's a very interesting talk, and I think I learned a lot from you today. And my question is quite simple, and I just maybe you could please give us more information about what the role of the development bank play in terms of their increasing the small medium firm in terms of participating in the regional and global market. Like I'm particularly interested in recently the asset in Asia. So I think there will be very good opportunity for a small medium firm. They be interesting to participate in this kind regional development or regional markets.
And Stephany, if I can give you a context, John Hong is a colleague in the department and has been consulting for the Asian Development Bank. So is coming from that kind of perspective with the insight into how these banks work. Thank you.
Thank you very much. Do you want me to answer now? Or?
Yes, if you could, yeah.
Sure. Well, I think that's a really interesting question. I think a very important role of development banks is increasing funding for SME, and I think the interesting link you raise is with exports, of course, which I must say the Asian economies are great experts. So it's more what we can learn from you rather than what you can learn from us. I think there are very successful development banks, particularly including in Asia, of lending to SMEs or using other mechanisms. For example, in Mexico, Nafinsa was active through factoring, paying companies before the creditors pay them. So you can have different non-traditional mechanisms. And also, I think different mechanisms for reaching very small SMEs, which I think is the most difficult. It's the most transaction expensive. But I think, I remember interviewing a colleague of mine in Chile who was heading Banco del Estado, specialized in lending precisely to SMEs and microfinance enterprises, micro enterprises, especially in the rural sector. And he said, I don't allow my staff to give a loan unless they visited the borrower. And I think, you know, knowing the client is something that's so lost now with all this kind of globalization and everything on the computer. Seems to be really important, and combining it with technical assistance, combining, you know, do they know enough about accounting and about, if they're looking for new markets, how can you support them? I think that is a really very important area. And I think, you know, if we do this work on Africa, I think it would be very important, of course, to focus on lending to SMEs. Also the work that the African Development Bank does, because it provides loans to national development banks and other commercial banks to lend to SMEs. So I think that is important. And also important is, I think, to make sure in a way that you have a good payment record. Because I think
compared to the private firm, a private bank, is that development bank, do they have any better saying advantage in terms of lending money to the small medium firm? So compared to
that's a good question. I think they may have the advantage, for example, that they can provide subsidies. They particularly subsidize perhaps their own costs, their own transaction costs, because it's very expensive to do this kind of detailed evaluation, even visiting them, as I was mentioning. And so the big commercial banks tend not to be so interested because it's not so. So I think that's an important advantage. Having branches, if you have a development bank that has branches in different regions, so they can again know the companies better, the individual companies and the market context. You know, what are the prospects for marketing in certain areas, or as you mentioned, perhaps bringing the knowledge of export markets. I think that could be advantages. But there could be, for example, the case where you combine, where a public development bank, like say the German KfW, channels the money through commercial banks, which is one model. The French, for example, they have a relatively new development bank called PPI that are more focused on equity. They, on the contrary, have branches. So they themselves evaluate the companies. So I think you can have different models. I don't think you have to sort of always think in terms like, you know, public or private, but what is the best mix to achieve the best aims, where the comparative advantages lie.
Okay, I think that one of the difficulty for the small medium firm is their information asymmetrics. So in terms of collecting the local information, do you think the development bank have a less advantage compared to the local regional banks?
Yes, I mean, I think that there the tension is not so much public versus private, but centralized and local, as you say. Yeah? So, for example, you know, if you have a very big development bank, which is, you know, good at making infrastructure loans and so on, but they can't lend in some faraway province or in another country. So they will need some kind of local intermediary. And if the commercial banks function well, in this sense, then you're completely right. I mean, they will then function with better information asymmetries. I was involved in some discussions in the UK, and you know, how would a development bank look here, an investment bank? And one of the concerns was that the commercial banks are not very prone in the UK to lend to, in general, to corporates, in particular to SMEs. So then would you strengthen them, or would you create also a regional development bank? So that's I think the kind of dilemma which probably depends on the country context, I
think. Yeah.
Thank you so much.
Thanks, Stefan. Could we move to a second question, this time from Desiree Kanga?
Thank you very much for this presentation. Just a quick one. Do you think that countries can leverage on welcome as well as pension funds to develop development funds and also to develop their activities? Do you see any risk? How can they how can this kind of fund be recapitalized like development bank like that?
Sorry, we have a connection.
I think we have a connection problem. Let me read the question. Say that Stephany, do you see any roles of sovereign wealth funds in the capitalization of development banks? What role would sovereign wealth funds play in the development, therefore, of development banks? I think, a very interesting question, because you have countries funding from their, budget funds, the work of the development banks, but at the same time setting up sovereign wealth funds for long-term finance. So it is reconciling these two. Maybe your insight might be helpful here.
I think that's a really interesting question. I haven't thought about it enough. I mean, I've worked on sovereign wealth funds and I've worked on development banks, but I think what you're suggesting, this link, is extremely interesting. And for example, I would think in particular, say, if an African country finds, a new natural resource, or the price goes up, and then they have resources that can go into a sovereign wealth fund, or more broadly into foreign exchange savings. So I think if they're thinking long term, they want to make the economy more productive, more efficient, more fair, whatever, go into new sectors. It would be a very good idea, I think, to use some of that money within their own country, capitalize or create new development banks. I think that would be, because Stiglitz puts it nicely. He says we have this system where you have this long-term savings or earnings, and then you have long-term needs. But then you have a private financial sector that's good at churning money. So how you build this bridge, and of course, sovereign wealth funds and development banks are key institutions for doing that. And so I think that's a really interesting idea, and it would allow also developing countries who have a lot of additional funding, and sometimes they don't know how to spend it all. Have a sort of bonanza. Then to channel this. But there's also the possibility that you have these sovereign wealth funds that are international, like the Norwegian one or some of the Arab oil exporters and so on. And they tend to invest in shares, bonds and shares. Now, it would be very interesting to talk, to see the possibility that they would invest in, for example, increasing the capital of development banks, or in particular programs that they have. And they would be assured quite good returns, quite reliable returns.
I think this is vibrating.
Yes.
I think this is an interesting question, and I like your response, Stephany, because if you look at it from the corporate finance sense, the tools, analytical tools we use to measure the performance of mutual funds and sovereign wealth funds are structured around the RFR and around the risk, the beta, and the return of the fund. And that's what the fund would be looking for. Sovereign wealth funds are looking for, the performance of managers to look for the highest returns. That's, the outperformance of managers, the alpha, and then the return on that fund. and of course, risk adjusted. Now, the transformation development banks would mean that they are looking long term, but they have to look into the projects they invest in, that they wouldn't be projects that would be able to earn a return, above the expected, return. So if they can do that, I think the two would be able to link the work of development banks and sovereign wealth funds. So I think this is a very important question, and should be reflected in some of the works. So Francois Botiono, you have a question? Could you?
Yes, thank you very much for this great presentation. My point is that recently we have seen that development banks have been involved in instruments like project finance and public-private partnership to finance infrastructure in order to reduce the risk. And I would like to ask that if you do find links between the use of these instruments, risk reduction, maybe financial engineering risks, and the development of these banks. Thank you.
That's a really important question, and it's a little bit related to the paper that I was presenting at the end of my presentation. I think it's the way you think about risk. For example, the World Bank talks often about de-risking, as if, and sometimes some of the people at the World Bank give the impression there's a magic wand and you wave it around the project, it becomes de-risked. But I don't think that's true in general. I mean, there may be a case where governments, for example, can help de-risk by providing a better policy framework, for example, better macro context. The case I mentioned of regulation of, say, utilities that are not providing a stable price framework. So that can be improved. But in most cases, we're not really talking about de-risking, but we're talking about a transfer of risk from the private to the public sector. And that's fine, a sharing of risk, but it has to be explicit, transparent, not opaque, as some of these instruments are. It has to be also well priced, because often these mechanisms are not properly priced. If there's a need for a subsidy and it's justified in policy terms, that's fine, but it has to be transparent. If there's no need, why do it if it's commercially interesting? So I think it's important to have a clear policy framework that defines the amount of risk that will be transferred, and also how it will be priced, and finally how it will be provisioned by the development bank. Because I have the impression, in talking to colleagues, like in more detail, more bilaterally, that in some of these development banks, they underprice and under provision potential losses. And that may go well. I mean, if we're lucky and the world economy is growing and the country is growing, the projects are good, then that's all great. And you've crowded in all this private money and it's fantastic. But for example, if things go wrong, like now they're going wrong under COVID in a major way, then, who bears the losses is not just academic. So I think it's very important to to strike this balance. Of course, you want to attract private money, and therefore you want to, where necessary, where the profits, the risk return, as Victor so nicely put it, is not attractive enough. You may, for example, provide guarantees, or you may increase profitability. But it all has to be transparent and carefully measured, which is, of course, and I think some of the PPPs that have been done, and development banks like the European Investment Bank actually were major promoters of PPPs, but some of the PPPs have proved quite expensive in the long term for the government. I mean, in the short term it's nice because you take it off the balance sheet, so you're not, you maybe give a guarantee, but it's it's below the line and it's lovely, you know, your deficit doesn't grow, it's all done by private investors. But then if these say roads or something go bust, go bankrupt, then you shoulder the liability. So it all, as I think, for example, happened in France many years ago, they provided massive guarantees for toll roads, and then suddenly, you know, if the estimates weren't right. So I think the guarantees, for example, the PPPs have to be very carefully targeted, and as I said, be transparent and be properly priced and provisioned. I mean, the British government, which is not a particularly left-wing government, as you know, has actually stopped doing PPPs from the time of Theresa May, because they thought the outcomes were too expensive. So I think, you know, one has to think carefully about that.
Thank you so much, Stefan. I think those responses are absolutely delightful and very helpful. This discussion is going to go on for quite a long time, because there are important issues we are looking into here. You know, the last one you touched on, the public-private partnerships. You know, and indeed, it's a difficult terrain. And the debates keep on going with how much the public sector can shoulder from the private, you know, kind of enterprise. And I also want to kind of mention a couple of names we're delighted to have here on board here. I could see, you know, old friends like Machiko. Machiko, welcome to this debate. Remember recently, you know, your good paper on debt and debt management. I can see also Rose Ngugi from the leading think tank in Kenya, the Kenya Institute for Public Policy Research and Analysis. I can see Amidu Mohammed from University of Ghana, Legon. I can see Ahmad Hassan Ahmed from Loughborough. I can see Xiaoming from Liverpool Jiantong University, even when it is almost midnight in that country. Thanks for your participation. And I can see Esme Kanyumbu from the Reserve Bank of Malawi, in addition to the other names I mentioned at the start. I don't know whether, Patricia, you may have something to add from your observations being at the helm of one of the active and successful National Development Bank in Africa. Maybe you can pose a question or say a couple of comments if you don't mind.
Thank you, Prof. Victor. Thank you, Stephany, for the presentation, and thank you for inviting me. I must say I have enjoyed the conversations, and yeah, I just wish to make some interventions from a practical perspective. One, regarding further research, and specifically for DFIs in Africa, I can't provide support in terms of access to all the DFIs in Africa. I think this is because I sit on the board of the African DFIs, and we have about 54 members. So I can support with accessing those institutions for further research. You talked about autonomy, need for autonomy, and making the national development banks independent in decision making. I think that is very, very relevant and very important, and it's actually one of the issues that we currently having conversations on at the apex body of national DFIs in Africa. But for this to happen, my experience as well is you really need strong leadership. In the case of UDB, yes, we are able to be autonomous and to make independent decisions. But I don't know, maybe this is what my question would be. How can we shield or protect DFIs further from kind of operating not quite independently? Because those tendencies would be there. For as long as you are owned by your government, like in our case, we are 100% owned by the government. But what supports our structure and our operations is that the bank is incorporated as a company. So we run this business like a company, and like most DFIs that I know that are not maybe incorporated as a company, maybe they are established as an act of parliament, and then you have maybe the shareholder, the minister appoints maybe the CEO or the board, etc. So in that case, it's really very difficult for them to operate independently. So that really needs to be addressed for national DFIs, especially in our region, because I know for a fact that most of them are not progressive because of this kind of structure. So what would we really have to do to ensure that they can have the right structures to enable them operate independently? The other issue is on funding. First, on scale, I totally agree. If the scale is very small, the impact would be very small. For DFIs to increase in scale, they need to get funding. And from my experience also, it's very important to diversify your sources of funding as opposed to just rely, say, on capital from your government. Yes, it is cheap funding, but there are opportunities to leverage end times to be able to grow your funding base and therefore be able to grow capacity. But for you to be able to attract funding, then the DFIs need to be strong, okay? So they need to be strong in terms of performance as well. You spoke about it. They need to balance financial sustainability with socio-economic development. And again, from experience, I have been in this organization at times when it was not strong. And I am still here in times now when it's believed to be very strong, and it's totally different. Now that we are seen to be strong, funding is no longer a challenge, even from the government that is the shareholder or from other funders that may want to support the bank. So another takeaway from there for me also is when it comes to funding, there are also lots of agencies and people that are selling money. So again, I need to be able to know what is the quality of funding that I need to be able to deploy to the kind of investments that I need, that I know are required in the economy. So that is another perspective to it. But key point here is, yes, funding is there, funding can be arranged, but if the DFIs are not strong, they're not going to attract any funding, they're not going to attract any capital, because probity funding only flows where, you know, it can be managed quite well. So even when you try or attempted to get funding from, say, climate funds, they still want to look at how strong are you, what are your processes, are you even rated by an international credit rating agency, etc. So at the end of the day, it comes back to building strong institutions that can be able to attract funding in whatever quantities. But yes, scale is very, very, very important, because that's when the impact will be great. That's when we can begin to kind of make an impact. Then on climate finance, mainstreaming climate finance, also very, very, very important, and issues of sustainability. And again, what we've tried to do here, and there is effort to support other African DFIs to do this, is mainstreaming issues of sustainability. In UDB, for example, we have what we call our 3 high impact goals. The first one is to reduce poverty while protecting the natural environment. The second one is to build a sustainable food system, okay, because we know the basis of the country. Then the third is to promote sustainable industrialization. So by taking that approach, we kind of try to mainstream issues of climate change, environmental protection in what we are doing. And we have seen a lot of value in this, even in terms of helping our business really progress. Then on project taking and project making, very, very important as well. In here at UDBL, we actually do what you call project preparation, creating projects. And because we realize that even the government sometimes, we realize that funding is actually not a problem. We used to be here and then we get lots of people coming and saying, we have funding, but we need projects, and the projects are not there. So even when the multilaterals approve funding for government, this funding gets cancelled because the implementing agencies maybe do not have the capacity to prepare these projects, okay? So that is where we saw a gap again in the country, and we said, can we support, help, the economy, help the country kind of fill this gap, structure, create projects. So we're able to identify even national projects or private sector projects that we believe would have a high impact on the economy if implemented, and then we'll take them through, concept notes, pre-feasibility, feasibility, structure them until, they are bankable. So you're again right when you talk about DFIs need to be able to create projects and not just take projects. In terms of COVID, what opportunities kind of came through? Again, I think I must say that I think as UDBL we kind of benefited, or we are blessed, okay, by the COVID situation, because government had to identify us as a key partner to implement part of a stimulus package, which was supposed to help the country be resilient and overcome the impacts even post, okay, the crisis. So we identified to implement a government program around import replacement and basically ensuring that the country has adequate supply and production of essential goods. So government then had to put in a lot of capitalization in the bank, and I think at that point, just in 1 month, our size almost doubled. As a result, but the advantage is what we were asked to do was already in line with the mandate, our direction and strategic direction. So it was kind of a natural fit as a result of that. And we continue to see how best we can support the SMEs, support national priorities along those lines. Financial regulations, this is also very, very key. In terms of having appropriate financial regulations for DFIs, I agree that what may be there may not be appropriate. And like I mentioned, the problem that we have around autonomy. At one point here, we said, okay, probably we need to have some kind of regulation, but really to protect the bank. Currently, we don't have any issues. We're able to operate, with autonomy, but down the road, you never know what may happen. The current structures in government may change. And without that kind of protection, you never know what the shareholders may decide. So we're also thinking about what is the right regulatory framework, but what we're really looking at is to shield the bank, to kind of secure its long-term survival, or not be able to go back, where the bank was very many years ago. And in relation to autonomy, I think this is important. But in designing these financial ETC regulations, what we are trying to do here in the country is working together with policymakers like the Minister of Finance and the Central Bank to see whether we can agree on what kind of regulations would promote the bank and would be more relevant. So we're kind of involved in this process as well. Maybe in terms of further research, another issue that we are dealing with or discussing is how, as national DFIs, we can just move beyond financing projects, etc., but begin to be in a place where we can help influence and shape policy in the country. So kind of be able to sit at the policy tables with government, having conversations around where policy issues should go. For example, if you talk about an industrial policy for the country, if as a National Development Bank, I understand that better, I can take leadership or have thought leadership in that area, for example, engaging with relevant policy organs within government and all the other stakeholders, just so to make sure that this agenda can move forward, especially where you identify that there are gaps. And as a national DFI, I'm well positioned to come in and kind of fill that gap. So maybe that is an area that can be looked at in terms of further research as well. I think that will strengthen the position of national DFIs in their economies. So that is what I can talk about in terms of an intervention. Otherwise, I look forward to any further recommendations or improvements in the way that as DFIs or national DFIs, we really can be more relevant in our economies. Thank you.
Thank you so much. I say, CEO Patricia Jangola, this is absolutely a gold standard. This is also a good standard, high quality and spot on. Much appreciated all these points. I think this meeting today is producing the foundations of a large conference or maybe a book out of it. I think we are we're just actually just putting together a foundation, for this great work to be done. And delighted that Patricia is at the board of this African Wide DFI. So we'll possibly touch base after here and try to see how we can make this happen, because this is a truly transformative area of the national development banks in the long-term interest of Africa. And as I mentioned, we are launching the Economic Report for Africa 2020 with the United Nations Economic Commission for Africa, in which project I've been working. And we are launching this next week. We will get some invitations on this to come to the launch. It will be about, innovation, innovative financing of the private sector in Africa. I think one of my contributors to this volume was Stephany herself here, as I very well remember. So I think this is a big agenda, and I think we have to research it, see how much information and knowledge we have just been able to, get together in just a space of under 2 hours. So I think thank you everybody who's been able to make it to this meeting. Thank you greatly, Stephany, for exciting us and provoking debate. As usual, something you do tremendously well. I don't know how you do it, but as usual, you have done it again. And thank you, participants, and thank you, Patricia, for being able to do it in spite of your very heavy schedule. So I look forward to seeing you next week to another exciting seminar. But for now, thank you very much, and bye-bye for the day. Thank you.